Now, Doctor, thank you very much. I didn't know we were number 5. That's pretty good. I think that's what you said. Isn't that what you said? I've been introduced before, but never like that. Dr. Lynn he is absolutely, I mean, the energy of that man is infectious. So, Doctor, thank you, and thank you for your guidance along this way as well. And I can get rid of this now? This one, I'm wired. Okay? All right. Again, welcome everybody, and this is our 3rd annual time of doing this, and we appreciate all of your support for Cal State Fullerton. You don't go from number 18 to 13 to 5 without support of the community recognizing that and getting involved. And it is something that our company has just felt it's an important thing to give back. And I went to Cal State Fullerton, as I said. I was a little upset today when I came, my badge said Pat Donahue 75. I was 78, Doctor. I'm glad you corrected it. You would have had a new moderator next year. But I enjoyed my time at Cal State Fullerton. As we talked last night with the panelists, I started at Santa Barbara. And after even I had some wisdom at 18 years old to realize I was never going to get anything done at that point. And then I went to UCLA briefly, and that just seemed to be much bigger than I was used to. My first class was bigger than my high school, and I couldn't figure out what to do. And I had a brother that lived on 41st Street down in Newport Beach, and he was a counselor at Orange Coast. And he says, "Pat, what do you want to do?" I said, "I have no idea what I want to do. But if I would like to know what to do with any money if I ever made it." He said, "Well, that sounds like business to me. Fullerton's got this great business program, and you should go down and you can live here in Newport and commute." And that's what I did, and it worked out fantastic. And I'm very proud to be an alumni of Cal State Fullerton. I love when you meet people in business. You know what they say about Stanford and Harvard people. Right, the first thing out of their mouth is, "Hi, I'm Jim. I went to Harvard." You know, so I always come right back. I went to Cal State Fullerton. Now what are we going to talk about? But I'm going to let the panelists talk today and introduce themselves. Okay, well, Lynn did a fabulous job of introducing me. I'm going to talk a little bit about our company and give you a background on our company. I'm going to show these guys how I want them to introduce themselves. Okay, so just to kind of, this group needs a little help. This group, they're quiet, they're very unassuming, shy, I guess would be the word I'm looking for. First off, a couple of rules. You can ask a question at any time during this luncheon. All right, so if somebody says something you want to follow, just raise your hand, okay? If I don't see it, then shout it out. That's fine too. But it's that kind of a meeting, and I've asked the panelists, I want to make sure they ask questions of each other. We had dinner with most of us last night had dinner at my house in Laguna, and there were probably more than one bottle of wine that got popped. And we had a great conversation. If we can capture half of the conversation last night, it'll be well worth your time today. But so just make sure you do that. I also want to know, who are we talking to today? I'm thrilled at the turnout. I think we're at 180 people or something like that. But raise your hand if you're on the financial side, if you're a banker, a lender. Okay, so quite a few. Okay, so a lot of capital in the room. Okay, how about if you're a broker of either capital or of leasing or investment broker? Bob, raise your hand. You're the one here. Okay, so a couple of brokers. Okay, they don't need any education. Those guys are all so smart. All right, how about management? Do we have management on the operations side of the business? Okay, I know we have some students. Where are the students? Okay, excellent. Students, by the way, welcome. You upgrade the room dramatically with your energy and your youth, right? I mean, how about Dr. Lynn saying this panel was gorgeous? I can tell you that Guy Johnson has never been called gorgeous. being here because I think it's important and for you guys to come away with this. So, again, just the ground rules of what this is. This is a conversation with some of the best guys in the business at what they do. And it really is, there's no PowerPoints, there's not a lot of statistics, it's not a lot of notes you're going to take. It's simply trying to tap into where they see the business today and where we're going. Okay? But I want them to introduce themselves, but I'm going to introduce our company first. Donahue Schreiber, it's an old established company, been in the retail business. We used to build big malls around the country. We redid Fashion Island for Mr. Brenn in the late 80s. Glendale Galleria, we built from the ground up. Galleria, and over a series of transactions, we are owned 95% by JP Morgan Strategic Fund and New York State Teachers Pension Fund. All right, so I'm an employee of those investment funds. We have about $2.5 billion of assets across 80 shopping centers. All of them now, instead of the mall business, we've gone into the neighborhood center business. So we would have grocery anchored, and if you're in the business, you hear about neighborhood or strip retail, that's who we are. We would look like a Wine Garden, a Regency, a Federal Realty. We would be, those are public, we are private. We're from Washington State all the way down through Arizona and Nevada. However, we'll be getting out of Arizona next year. I just don't feel I can compete in Arizona. I'm not down on Phoenix necessarily. I just don't feel we can be competitive down there. We have revenues of about $200 million. I mentioned the market cap at about $2.5 billion. Employees, about 150 employees. About total square footage, just over 10 million square feet. And I'll talk occupancy and stuff as we talk about that later. Okay? You guys can get close to that. I mean, you won't be nearly as good. You'll be close. You go ahead.
Okay. Guy Johnson, President Johnson Capital. Thank you very much for dinner last night, Pat. Since you gave me a little bit of a hard time already, I think there's an explanation between the 75 and 78. Could have taken you maybe a few more years. That's what I was thinking. That's what crossed my mind right off.
So, by the way, just file that away because he's going to get hammered. Pat, he knows about that. He was on that same program.
So was Steve, because we graduated at the same time. We went to school as well together. So, yes, that's true. Good for you. All right, so Johnson Capital, we were actually started an offshoot of a company that was based in Texas, but we were headquartered here in Irvine and have been since 1987. Basically, we have 20 offices throughout the country. We have some international activities. What probably makes us a little bit unique, there's many more banking companies, Northmark, CB, Richard Ellis, I see in the audience, Holly familiar with many, but we are still independently owned, no outside shareholders, no outside debt, no preferred stock, no preferred debt. So truly, probably one of the last remaining independent companies in the country of any size. Mortgage bankers, to do what we do, we'll do all product types, industrial, retail, apartments, office, hotels, whatever, self-storage, all the different product types. And we use many different sources of money. So we might be a broker. I didn't see, a lot of people are brokers here, they didn't raise their hand, by the way. I wouldn't be so embarrassed about it, but occasionally, we might, 4 people raise their hands.
The rest of you people.
A couple of you did not raise your hands, very, very sheepishly, by the way. Some of our most successful people in our company actually did graduate from Cal State Fullerton and some of the other Cal State schools, but one of my longest time employees is from, or co-workers is from Cal State Fullerton. So we'll do all the types of debt. So we'll arrange debt, we'll kind of find where the opportunity is. So one day it might be working with a life insurance company. The next day it might be working with commercial mortgage-backed securities, CMBS, so here quite a bit. The next day it might be working with a bank like Wings. The next day, if you're fortunate enough to be in the space, which everyone isn't as a mortgage banker, you might be working with the GSEs, which includes Fannie, Glenn, and Freddie, and FHA, and we'll issue Jimmy Main Security, which has been a big business. As far as where we're growing, we kind of like the organic growth, not having any outside ownership. There's a lot of squeeze. I know a lot of you guys went to, and ladies went to a cocktail party last night. There's a lot of emphasis on bundling services together, so we provide the financing, perhaps do the investment sale, and vice versa. We haven't done that. There's a reason that we haven't done it, but we haven't viewed it. I hope to be around for a while. We're going to do something interesting this year, which we've never done. We're going to give away about 20, when I say we, I'm going to give away about 20% of the company. I should have done it a long time ago because, they're going to end up owning it anyway. Otherwise, they will say I quit working. Most of our assets come and go every night in that elevator. I'd say the only place we put long-term assets on is when we service loans. So we're going to get away a percentage from the company so we can figure out how to document.
How much volume a year?
Well, this year, last year we did $2-some billion. We've done $50 billion over the last 20, 30 years. Really good years, $6 billion. Not so good year. You get skewed though. It's not so for us. Profitability isn't necessarily volume.
No, I'm just. But I'd like to.
Several billions, and we've got offices across the country. California's been a big part of our story. We've done business with everyone here, a lot with some of the people down there as borrowers, and kind of a couple billion would be great. 4 billion, 5 billion.
Yeah. Okay. Great. All right. Well, in your program, it said that John Hagestead was going to be here, and I want you to know that we got a much better looking guy, John Hagestead, and a much younger guy. But John was signed up, and something came up. It's called the Super Bowl. And, he was gracious enough to send me an email and say, I got tickets and 3 days of events at the Super Bowl, and I'm going to opt out of this deal. What are you supposed to say? But he said, I got somebody that'll be even better. And we have Peter Rooney of Saris Regis. So Peter, tell us a little bit about you and Saris Regis.
Sure. Saris Regis is a privately held developer here in the western U.S. We're headquartered in Irvine. We specialize in apartments and industrial buildings. The apartment side, it really is the western U.S. On the industrial side, it's really California. We manage roughly 15 million square feet of properties for our partners, plus another 15,000 apartment units. Currently under development, we've got about $850 million worth of projects, and it's amazing. It's a pretty equal mix. In the apartment side, it's about $450 million worth of apartments. On the commercial side, it's about $400 million worth of industrial. Okay,
excellent. Fantastic. We'll get back to occupancy and stuff in a little bit.
Yeah, occupancy. We're just building.
You students out there, don't look that up. Steve Case from the Irvine Company, representing the office sector.
Yes, happy to be here. It's an honor to be here, and I think we're going to have a good discussion, right, guys? All right. Just 30 seconds on the Irvine Company. I think most people are familiar with the Irvine Company. Probably the company is best known for its community development. So that's planning communities like the city of Irvine and developing homes. And I'm on the investment property side, so there's 2 divisions. And investment properties, there's retail, resorts, apartments, and then the company I work for, the office company. We're primarily a coastal California company. The strategy is really along 4 markets: Silicon Valley, West Los Angeles, of course, Orange County, and San Diego. We have about 480 office buildings that total approximately 44 million square feet.
How would you rank nationally as an office building owner?
It's a good question. We would be, I think, in the top 5.
You would be.
And it's primarily in California. So,
right.
The EOPs of the world used to be up around 100 million. There's no one that has a portfolio like that now. So
it's all been broken up.
Most of it's been broken up.
Did you also mention last night, Steve, that you're in Chicago as well, or somewhere?
We do have a couple of assets in Chicago. That's not part of the strategy. It's just there are some unique opportunities.
Just started there. Right. Okay, excellent, excellent. Colin Mackin.
Sure. Colin Mackin, I'm president of Shea Properties. So we're the investment arm, essentially, of the Shea family. Shea Properties, we have about $2.3 billion in assets, maybe 65 assets in total, 6,000 apartment units, and about 6 million feet of commercial space. There's 3 businesses in the Shea family of companies. There's heavy construction, home building, and properties. So kind of fun. It's a real fun company to work for. I got to see a lot of things besides actually, commercial space. Still family owned, and the Shea legacy's been going on for about 125 years, so it's kind of fun.
Remarkable, remarkable. Wayne Brander, U.S. Bank.
Well, I'm just here to make sure the storyteller's audience in and tell my lenders. What are the real rents, guys? So, most of you may know about U.S. Bank. I'll give you a quick backdrop. We're based in Minneapolis. We're the 5th largest bank in the country, about $300 billion, $350 billion of assets. In terms of, and as a regional bank, we're really focusing on the consumer side, the business lending side. We also have a very significant fee-based business and on the merchant processing side. So what we always talk about, if you have a credit card in your wallet, 1 in 5 chances we are that credit card, just like the name on it. If you go into gas and buy gas, 1 in 3 chances we're that processor there. So we make a lot of steady money there. And so the net result is we fared very well for the last 5 years. We've had a very steady income stream. In terms of our core real estate side, we have about $35 billion in commercial real estate. We have 25 offices nationwide. I focus in on California. We have 5 offices in California, from San Diego, Orange County, LA, San Francisco, and Sacramento. And then what we do is we finance developers, we finance investors, and I look around the room here, we also partner with a number of these banks in the room.
Excellent, excellent. And for most of you that don't know, Richard Davis, the CEO of U.S. Bank, is a Cal State Fullerton graduate, so just so you know that. Wayne started out and found Santa Barbara to be more to his liking than mine, and ended up at USC in graduate school. And then there's Trojans all over the place. Peter, did you go to SC?
Cal Bear.
Beautiful. Boy, my gosh, darn, that feels good. Usually this whole thing's Trojans, you know. It's just tough for a down.
We work with all Trojans.
I know, we all do. We all do. You guys are like cockroaches. Never just one. No, I've seen it. Some of my best friends. One of the things, as you saw, every of the commercial disciplines is represented here, okay? So we want to try and talk a little bit in general terms about that, but most importantly, not most importantly, we always start this off with the capital, the money. What's the money want to do? Because I just feel very, as I look at our business and coming from a very entrepreneurial model now to much closer to an institutional model, that our business has changed. If you look at it, and Dr. Lynn, I would say that we're on the back side of the bell curve in the maturity of commercial real estate as a business model, particularly in Southern California, where much of it was spawned. And so I think the capital is really critical. And it's one of the things I like to promote when I'm a company. That's the strength, besides our people and our products, but the capital structure really makes it different. So I think you got to follow the money and see where it wants to be and where the economy is going. So Wayne, give us a little bit of your take and the bank's take on the economy. I just came out of a session with ICSC's trustees that all of the government intervention, or whatever you want to call it, recovered from where we've been. Any comments?
You know, I agree. I think 2 things. If Washington would just stop making decisions, and second, if we stop reading newspapers, everybody feel like they're about things. If you look at it, it's really tied down to consumer confidence. That's really what it comes down to. You look at consumer confidence, it took a big dip in the 4th quarter last year, and it's really a result of the worries or the fiscal cliff, the debts, and a lot of other factors. But the consumers represent 70% of our economy right now. And as much as we talk about unemployment is key. You have to think about the employment factor, and we'll call 10% unemployed. 90% are employed. You have to have that 90% employed begin to spend their money. And if you can get them confident on certainty about their economy, they will open up their purse strings on it. When we think this year's going to be a slow year, I don't think you're going to see a lot of movement out of Washington. I think it creates greater uncertainty not only for consumers, but also for businesses. And if you look at business investment, we look at our lines of credit. So we provide capital to corporations and business to invest in their inventory, to invest in property and equipment. And we're at an all-time low right now. So our normal outstanding is about 40% of a commitment. And corporations are now running about 25%. So what they've done is they've taken all this excess cash flow over the last 3 years, they've deleveraged themselves, but they're not investing today. And there's really 2 reasons. One is they don't understand the implications coming out of Washington from taxes and other factors. And secondly, there's no urgency to spend money. Because if you look at interest rates today, you look at the forecast for the next 2 years, there's maybe 20 basis points, maybe 40 basis point uptick in interest rates for the next 2 years. So if you have capital on the sideline right now, not seeing interest rates going to spike, you don't know what's going to go on with Washington, you're not going to make big decisions. I mean, we think that's what we're going to do to try to the economy.
So if I look at 13, on a scale of 1 to 10 from the consumer standpoint, where is it? Is it a 5? Is it a 4? Is it a 6?
I'd guess 6 to 7. You know, if you
Okay,
think
so
about,
it's-
because you think about the consumer side, the people who are employed are going to still be employed. And that's different than in 2009, where people still worry about their job and downsizing. Corporations aren't downsizing anymore. We're not hiring to the extent we need to, but we're not downsizing. So I think consumers feel good about that. What you are starting to see, of interest from the rest of the panelists, is on the home side, because if you think about the biggest investment for any individual is the value of your house. And we are starting to see some very positive indications on the housing side. It's not going to turn overnight, but we're starting to see some movement there. And that, I think, is going to affect the economy.
And you would be involved in that in just residential loans?
Yeah, well,
Construction loans?
Absolutely. So we see the construction loans, but we also see it on the refinances. So we've moved from, I think we were 15th in the mortgage business, now we're 3rd. And we've grown our mortgage business tremendously, and some of that is new originations, much of that is refinancing. And if I look at the housing market, there's 2 things going on. There's about, from what I read, about 50 million mortgages in America. And there's statistics that say about 20% of those are underwater today, right? And we'll call it 10 million mortgages underwater in terms of their value. And as values start to creep up, that's going to break those mortgages free. There are a lot of people who would like to go buy another house, maybe they have another child, maybe they need to get another room. But until that mortgage price, or the price of their house and mortgage equates to one another, they can't move. The other factor we're seeing is just lack of supply. And Shay's really big on the home building side. You look at available lots, there's no available lots. Look at available inventory. Outside of distressed properties, there's really not a lot of resales available, and there's very little new homes. And so the consumers who want to buy, one, they're worried about the mortgages. And second, they just don't have a lot of choice.
I just heard a stat that they gave at this last conference I was at last week, was that for every $100 increase in home value, $7 goes into retail. I don't know if it's true or not, but that's what they were saying. And this is not a housing conference, but it does drive so much of what we're doing. And I know it's not the specialty, but both Shay and Irvine are involved in housing. Are you guys hearing around the water cooler what's going on?
I think we saw a turn probably last year, and most home builders are up anywhere from 40 to 60% in volume. I don't think, and that's nationwide, right? I don't think that prices have just started to turn. Not sure in Orange County, maybe it's up 5 or 10% in the last, since the end of last year. I actually think we've seen the bottom, and I think that the home building side of our business is pretty bullish about the next couple of years going forward. Wayne did point out it's hard to get land, it's hard to find lots, especially coastal. I think we look at California, we're California and Colorado. We look at California and we draw a line down the coast, and it's you're on the coastal or you're inland.
It used to be north and
It's
south.
not north and south.
And now it's east and west.
Yeah, exactly. But I think that-
When you look at real estate now, that's what people do, and lenders and everybody else. It used to be northern and southern California, it's eastern, western, southern California.
But that is the bright spot for the next couple of years in the economy. And that's going to add, I don't know the statistics, but it could be 50 basis points to GDP, so it's a big number.
We can use it.
Yeah.
We can use it. I guess we're estimating now with the drag, we're estimating now 1.5. We could use another 50 basis points.
Sure.
Start to goof around with negativity again, and who knows about double dip and all that kind of stuff.
Right.
Steve, I know it's not your specialty, but in the Irvine company, you guys are building some lots and getting some things dusted off?
Yeah, there's really good activity in the home building side, and I think really what that means for our business is a leading indicator. It has been, and we think it will be this time. So as there's more consumer confidence, there's more activity there, we think that really bodes well for the overall economy.
Excellent, excellent. Let's talk about loans and money, okay? Because I think it's a very unique time. I don't think any of us that have done this for some time have ever seen the capital and the interest rates where they are. And somebody said last night, well, it's Japan, maybe that's what we are.
Steve said that.
Did Steve say that? Okay, we'll come back to Steve on that. Because I really want to know what you think about it. before we go to Steve, but talk to us a little bit about where you see, what's a loan look like today across the various?
Let's talk about capital. By the way, all three of these people are involved, or companies are involved, big time multifamily as well, which is housing. So I want to come back to that. And then, who's in the media here? No one? I agree with Wayne entirely, but I'd like to still read, papers and what have you. So write anything. Remember who's defending you.
Just write good stuff.
I hate to see you out of business, especially. So on capital, you basically have different parts of the capital stack. You'll hear the senior debt, which is basically what U.S. Bank will do, or life companies will do, or CMBS will do, or Freddie or Fannie. Then you have basically a whole other component that needs to be filled, which can be filled in a whole bunch of different ways, which can be mezz or equity, but you need that other piece. So let's just say senior debt goes up 60, 70% of loan to value, something like that, just for fun. Higher on the multi-side, because there's more activity there, more liquidity, partially funded by the government, largely funded by the government programs. So, yeah, we've never seen this. I don't think anyone in this room, I started the same exact career doing the same exact job, basically I have today, in 1983. It's been a continual decline, not always straight decline, in interest rates. So back in the early 80s, a 12% rate, or 11% rate, or 10%. People are dying to get 6 and 7% rates, but where are we today? Today, the high quality senior note, say from a life company, I'll talk about the banks, we'll wait to talk about the banks, but non-recourse loans, fully non-recourse, you're in the high 3s. You were in the mid 3s just a little bit ago. 10-year U.S. Treasury is yielding about 2%. Everyone kind of benches off that as a generalization. They've risen here in the last couple of weeks. Everyone's read about the various events that's happened. But figure high 3s, which has never been seen. Most people, and I think a lot of that people believe is driving real estate values to the increase in values. There are loans, which I will say, which we just did. When I see a couple competitors out here, but we just did a loan, and get this for anyone that owns a home, because this doesn't even exist in home loan environment. But we did a 35-year term, 35-year amortization, fully non-recourse, full leveraged apartment deal. Now, when I get to the rate, fully assumable without rate change. So anyone that has a home loan out there knows that their home loan is assumable without rate change. And no prepayment penalty whatsoever after 10 years on a 35-year term, and limited prepayment penalties years 6 through 10. The rate was 2.5%. Better than any home loan. Better than any loan anywhere else. And that was, of course, the government. It gives you kind of where the mentality is for investment classes. So what do you have? You have basically I'll generalize, two different types of lenders. You have lenders like U.S. Bank, that are portfolio lenders, and they're basically going to keep the loans, and the life companies are going to keep the loans in their books. You have this whole other business where we're selling yield to alternative investors, and they like what they see as far as absolute relative yields to other fixed income classes. So real estate, very, very, very bullish. The CMBS market, commercial mortgage-backed security market here is huge today. It was a big year last year. This year, everyone's predicting maybe a 40% increase from near death, by the way, of 5 years ago. So.
It used to be that the CMBS was kind of, you did it for rate, was the main reason you did it. Why do you do a CMBS now, and what's the hierarchy of the bank, the life insurance,
okay, all right.
the competition between the three?
Okay. It was so easy. The good news is I'd be out of business because everyone would be able to do it without people like ourselves. But, okay, so the life companies typically do best institutional, best of breed, best quality in their mind, borrowers, property types, and it's kind of basically binary. I mean, you either kind of be a life company type borrower, which everyone on this panel is probably big time, or you're not. So I don't think what drove the CMBS was so much rate, because only recently CMBS has competed with life insurance companies. That's because you got all these investors. But basically now, one lender, the CMBS lenders, are in the business of making sausages and selling off their risk. And they want to sell all the different investment classes within the bond classes. And you have another type of lender, the life company, that's portfolioing the loan. So they got to feel good about their sponsorship. They got to feel good about the long-term prospect. Not that the CMBS lenders necessarily don't, but they're laying off the risk. And they got a whole group in there that are the B piece buyers, special servicers, non-rated pieces, unrated pieces. And in theory, they should care too, because they're retaining that first loss position. But here's why people do CMBS loans, because they can't get insurance loans. I mean, insurance companies are dealing with a portfolio lender, and there's exceptions to that too, Alamoana or whatever these, single asset class, huge deals. where they basically pre-sold all to investment class, all the original securities. But looking at a large billion-dollar mixed-use hodgepodge, a lot of you look at a lot of retail in there. A lot of retail you probably get is excited about, is your institutional partners are excited about. They're typically not your basic neighborhood drug grocery anchor as part of security with right store sizes, right store footage sales.
So it used to be you went to CMBS, the rate used to be a little bit better?
No, the rate wasn't better.
Really?
Not the insurance rates.
Okay.
That's what Larry's telling me.
Okay. That's what I was told.
Maybe Larry's advisor.
So the rate wasn't any better, but you went because you got a little better LTV.
Definitely.
Definitely got
And
some
they
LTV
do things with borrowers that others wouldn't.
that others would.
Yeah, they wouldn't, yeah.
And is that now still, is it still the same measure? Is it still pretty much the same thing?
So there's two, I want to ask you a question, there's two organizations within the U.S. that basically kind of oversee our industry. One's the mortgage bankers, and I'm on the COMBOD or the board of that this year, coincidentally. There's another one where I'll get fired and shot if I say this, but it's called the Commercial Real Estate Finance Council, which is very CMBS-centric and based out of...
I'm going to move this way, if that's good.
With a single shot, not that big flag, but, yes, I think CMBS lenders will do things that life company lenders won't. And for those that earn my profession, because I see several, do any of you disagree with that? Yeah, okay, so one of your...
Explain it for the group?
Yeah, one of your biggest, advisors would agree with that too. So they'll do things that life companies won't.
Okay, so now, the 2.5 loan, it took the breath out of the organization, of the group, right? Okay.
Yeah, it's true.
But tell me, I come in, I got a
Not a shopping center. It's only for multi, so I just killed your story. Going to the
What do you mean, your moderator for next year?
Don't ask me more questions.
What, no, yeah. I come in, I got a B+, A- shopping center, coastal California. What's the debt look like? And I'd like Wayne and Guy to come. And
Well,
Wayne, you go first. What's the debt look like?
First, we're going to look at what type of shopping centers. Is it going to be community, lifestyle? Where's it going to be located? What is the tendency? Because that really drives the risk factors. I mean, debt-wise, we'll call it 65% loan to value. Okay, you're going to throw that out. But on retail, you're going to point that out. Retail's a tough deal for us because, unlike, if you look at industrial, it's somewhat generic. I know you need floor heights and everything a little bit different. If you look at office buildings, somewhat generic, depending on the tendency. But look at retail. I mean, retail is impacted not only by the general economy right now, as the other asset classes are, but you have something called the internet. And I went through a list of all the store closings in America in 2012. You just name it. I mean, there's hundreds and hundreds and hundreds of stores that are just gone. Walked by a Hallmark store yesterday, gone, right? And it's a Hallmark store, you just do it online. And so, Pat, if you think about your business, as we look at retail, we're really much more focusing on what is that tendency. We'll focus on the location, the need of that retail in that location, but what is that tendency on it? Who are the anchors, and what is it we'll call the mom and pop shops around those anchors? Who are those, how long have they been here, and what are they selling? If you have a shopping center filled with Radio Shacks, I'm not sure how long you need a Radio Shack there. Now, if you're a service provider, it's a little different.
Okay, say it's one that checks the boxes though. What's the loan look like? 65% LTV?
Yeah, it's about 65. So for us, we're not on the permanent side. If you want a permanent loan, you go to Guy and get your CMBS life company. Some of the banks here are pushing a little bit more term debt. So our financing is generally more than 3 to 5 years. So where we're going to fit better with the client is someone who's bought the center, wants to change some of the economics and centers or some of the tendencies. And once that center's been stabilized, either that center will be sold or refinanced on a permanent basis. So we're going to provide the flexibility to move that center around a little bit and some of the tendency on it, and give you variable rate debt versus fixed rate debt.
I see. Okay, and what's the pricing on the variable rate?
Well, I was with Guy here, I'm going to start high because he's going to work me low. So we'll call it 250. Generally for us, we're about 250 spread, a little bit less for core clients, a little bit
250
more.
over LIBOR.
Over LIBOR.
Which today would be?
Well, LIBOR's, if you're doing 30-day LIBOR, it's 20 basis points.
Right, okay. So you can see what this is doing to our business. I bought my first house at 18%. Okay? Some of you in the room did too. Right? You just don't remember that. Right? 18%.
30-year mortgage, too.
30-year mortgage. Oh, yeah. Yeah. So it's just, I mean, this is a remarkable time. I have a buddy of mine that has grown up in the business together with me, and he says if we can't make money in these interest rate environment, we ain't any good. So just whatever it's worth, I think it's an important piece of it. Guy, what's in really deference to him?
Yeah, I'd say very borrower-oriented, sponsorship-oriented, and also probably some element of recourse, right? So, okay, so I'm going to talk about non-recourse loans, CMBS, insurance company, high threes, maybe low fours, say, given the recent bid, but
High threes, low fours,
10-year term,
LTV.
10-year term, some call protection, maybe some complete call protection actually with life companies, CMBS, meaning you can't prepay the loan without paying a prepayment penalty. So there'd be yield maintenance, there's other variations. Max LTV, I don't even want to get into this because it's going to confuse everybody, but there's this debt yield concept and everyone focuses on that. It's basically kind of a cap where you take in a line to make things simpler. Just say 75, 70% loan to value, 65% depending how it underwrites. So everything we talk about as far as on retail, since we're talking about retail, everybody's very concerned. When there's been severity losses, when there's been losses in retail, they've been big losses. Because when you've blown it, you've gone way off the cliff. You start losing all your anchors, you lose your anchors in your shop line, your line space blows up, and pretty soon you got a real problem. It's not quite like an industrial building. You lose a tenant, it's generic, you put someone else in, or multifamilies, really, there's a need.
On rate and LTV, if you were doing a building for Peter, same as a retail deal, is it pretty much the same terms?
CMBS lenders are horrible at short-term leases because they look at lease risk and rollover risk. By nature, most of Peter's leases would probably be under 5 years or less. So CMBS really doesn't work well, but life companies work especially well. Some banks work well too. There are some non-recourse permanent programs.
So we're talking about industrial buildings.
Industrial buildings. People love industrials, especially you get to like the big bulk warehouse, 30-foot clear heights, right, parking ratios and radius turns and whatever it might be, concrete acres, storage space, whatever. There's no issue getting those financed through life companies. About 10 life companies only. So it's a pretty narrow universe, but the ones that understand it love it.
They like it. Apartment is the biggest dog in the room at the moment, and then really retail, good office, good industrial, they're all bunched together in relation to bad office, bad retail, bad industrial, right? I mean, kind of the have and the have-nots, both from the capital side.
I'd say so, but it really is more geographic based. So for instance, if you go to San Francisco, office is on fire on it. Office buildings are being sold at $600 a square foot right now. Now, if you have a Class A, glass and steel, you're going to get a discount. If you have old brick timber, you get a premium. Why? Because the internet companies want to be in the cool buildings. But what's interesting down here
is that right? So a high rise that we would have all grown up with, and
there is a cap rate differential in San Francisco. They have something called Market Street. One side you have the financial district, the other side you have South of Market, and it's probably 100 to 150 basis points difference between what side of the street's on, because it's about the building. And all the
but South of Market
the premium
is the premium.
The premium.
That's the part you got to register. And in the old days, it was the other way. It was at least 150 the other way.
And here's another interesting part about San Francisco. Again, I covered 5 offices throughout the state. So if the Irvine company came to us and said they want to build a spec office, we'd talk to them because the Irvine company good on what they do. Anybody else was saying, you got to go slow with office. In the Silicon Valley area, if you want to build an office, you better build 300, 400, or 500,000 square foot at once spec. Because the type of tenants that are taking that space want that kind of space all at once. And so you're seeing up there big buildings being bought on, or built on spec and getting absorbed like that. If you only build something 100,000 square foot, you're obsolete.
And who's taking it? This is Google.
It's tech and I'll call media-related companies, so the Twitters of the world, Facebook, others.
Peter, how's that changed your business? Are you playing in any of that?
A little bit. Let me go back to the office point, and Steve, probably will verify. You get into the Class A office, the traditional high-rise steel frame, the nice buildings in downtown LA. CPAs aren't expanding. Law firms aren't expanding. Banks aren't expanding. All your traditional tenants that want to be in that type of space are not. In fact, they're probably contracting. But you go into Venice and you go into some of the cooler areas, Santa Monica, and these old brick buildings, as Wayne's saying, that's what everybody wants. And they're paying premiums for those buildings. Google's major expansion up in the Santa Monica, Venice area. They buy all their own real estate. But it's the traditional office building, and then the Class B and Class C office building. They're really kind of struggling to figure out what they are. The traditional office buildings are going to fine, but occupancy is a bit of an issue. Where, you know, some of our partners have some very nice office buildings, and they're really struggling at 85% occupancy, where those buildings were 98% occupied for the last 20 years. Well, their bread and butter tenants just aren't doing well today.
Right. Well, while we're on that, Steve, what you guys,
If you have a Class B office building, Class B location, you have one thing to compete on, and that's price. And that's not a good place to be right now.
you become a commodity.
Absolutely, 100% commodity.
Yeah, I think that's a really an important piece of anything real estate as we've gone through this. I think all of us have come to the conclusion that that cannot be where you are. And it's hard to avoid that at times. You work in markets where you become a commodity. It's simply supply and demand. And you could have a Vaughn, in our sector, you could have a Vaughn's, and it's doing a lot of business, and the guy right across the street built 40,000 square feet of unanchored retail, and he's just ruined what you have. I mean, there's just no way to compete. It's a commodity. And so the Subway sandwich guy that was paying you $3 in Las Vegas is now comes to you and says, I'll give you $1 for 12 years, I can go across the street, because the third owner of the property, or now the lender, has said, just fill it up. And he's just taken everything down. And that's why the demographics in the markets, particularly, as Wayne said, in retail, is very, very different than some. But it's the same in office. I mean, we just can't become, and industrial. You can't become a commodity. Apartments have been able to avoid that for some reason, but just because people, I guess, need a place to live.
Can I jump on the retail side? Some retail gets bad retail at the right lower basis after it's been foreclosed on, a new person buys it. It works, like Hollywood Mihaylo, use an example. We've got basically cut in half. They can cut the rents in half. Where we've had a lot of retail issues in our servicing portfolios, basically the operator didn't do much wrong, but the person across the street bought their center for half as much, and they lowered the rents half, and hurt us too.
Yeah, I think that's really what happens. It's retail. You go back to the fundamentals in all of our business. And Colin, please jump in. But the retailer has to make money. I mean, none of us would sit here and continue to lose money and stay there. I mean, they'll do it for a while, but, and we love them when they do. But you eventually sit there and you go, hey, how can this guy make money? And what happens is you go and lease it, and things get leased at what is, quote, market. And every time I look at a project that we developed that went sideways, it was simply because we thought the rents were sustainable, and they weren't. They weren't. And I had leasing people, well, I got you $49. No, you didn't. I can't collect it because they're not doing enough business to pay the rent. And that, from a retail standpoint, is as simple as I can define it for you. And it's taken me 35 years to figure it out. Those at USC probably got in the first class they went to. But we had to do it on our own. But it really is, I think, a fundamental.
It's true. Bad retail is bad retail. It's just, we look at it that way. If it's a bad center, you can't fix it, right? I mean, our focus these days is on neighborhood centers, where it's a decent market anchor. Or, what used to be a power center of 500,000 feet today is 250, 300,000 feet. It's got a Target. It's got, one other box, maybe two other boxes and a bunch of pads. Because food, people are still going to have to eat. Food part of that business has come back pretty well in the last year, right? But it's what Wayne said, it's whatever you can buy over the internet. That's the people that are hurting. I mean, look at a Best Buy. They don't even know what size they are today. They started out at 45,000 feet. By the time the musical chair stocks, it could be 15.
Yeah, no, I think the internet has and the internet, I think one of the things, though, in looking at retail and the internet, it is clearly a major league issue that you have to look at. But there is a lot of things that you cannot do on the internet. I mean, I might be able to get my hair cut on the internet. You can't get your nails done, you can't get a Subway sandwich. We've listed all of our tenancies, and Larry Casey, who's in the room, our president, sat, and he listed all of our tenancies and went through it. And clearly there's issues, but we didn't get caught with, we had no circuit cities. You know, we have 3 Best Buys, all of whom do over $50 million, you know. Now, are they gonna get smaller? Yeah, they're gonna do that, but somebody's gonna eat up that $50 million.
How do you protect yourself from being a showroom for Amazon? Or how do you help your tenants?
That's the retailer, you know, the retailers. Yeah, I think one of the things you hear a lot about it, I can tell you, and it's dealing with good retailers, and Colin already mentioned. I mean, you know, Target, I mean, these guys are as sophisticated as the day's long. I mean, they know so much more about the internet and who's buying what and where and all this stuff. Safeway knows more about what you buy, or what I buy, than I want them to know about, you know? So they're very sophisticated. Retail is a very sophisticated model. It's a very low margin model, and that's why it's very sophisticated. So I don't really worry about that kind of stuff too much. I think, you know, I worry about JCPenney. I worry about Sears. I worry about Kmart. I just don't see them, but I worry about them because they've been asleep. And Target and Walmart and Kohl's came in and just killed them. And JCPenney's lost $5 billion of volume. I don't know how you recover from that. They're talking about selling, you know, they're talking about changing what they're doing, and they got the guy from Apple and all this stuff. You know, I don't know. We don't have any pennies, and I wouldn't buy. And I'm not buying anything with pennies. And Sears is completely, Sears and Kmart together. That's 2 drunks holding each other up. You're going to be writing that down. But I just don't, you know, when you look at Sears, I don't want to be on the when you look at Sears, they have 300 million square feet of space in the U.S. Simon Property Group, the biggest mall owner in the world and an outstanding company, has 240 million square feet. Sears has did I mention 300 million, right? Across the country. They have 5 people in their real estate department. 5 people. I met him. I met one of them, and he was a bright guy. And I said, you know what? I think I'm going to go buy some Sears stock. This guy is really a bright guy. We can move this. We bring this over here. I sell this to the developer. I do this. I said, well, how many of you guys are doing this? You got a lot of value in your real estate. And he says, there's 5 of us. I said, 5 of them need to be 500 of you. You know, and I don't know what the plan is. Now, Eddie Lambert is one bright guy. I mean, he's not, you know, he's no slouch. I don't know what he's doing, and I can't figure it out, and I don't want to have anything to do with it. So I worry about those kind of deals. I don't worry about the Targets. I don't worry about the Walmarts. I don't worry about the really good merchants. They figure it out. It's the world's 2nd oldest profession. You know, it really is, when you think about it. And that gets pickles, and then they go, what's he talking about? It really is, it's bringing goods and services to the market is really an ancient practice. And that's what they do, and they get very good at it. And I'm not, the internet, frankly, is additive to retail. If you sit here and don't embrace it, and don't watch it, and be defensive about it, you're going to get hammered.
So what happens to all those Sears buildings? What happens to all those buildings?
You know, I think a lot of them are in very good malls, like in Ala Moana, Colin, they sold it for $240 million to General Growth, I think, at Ala Moana. So that, you know, they don't have 300 of those, but they got enough of them to be able to do it. Some of them get demolished. You know, the good real estate, the malls that are fortress malls, from an investor standpoint, the fortress mall is as financeable as anything you would have, correct?
Yeah, dominant.
Yeah, that's what I mean. The dominant fortress mall is still at the absolute
You want to
hierarchy.
verify the sales, of course, but
Yeah,
broadly speaking.
but just tremendous. I was very surprised at that, because I've been in the mall business.
No, they perform.
Yeah, they just keep performing. They keep performing. So, you know, I think
Got a big one right here.
they got a real good one of the very best, and very well run. They know what they're doing. But, you know, I think it's, you know, there's a lot of saying, are we overbuilt or under demolished, right?
Well, that's one of the things we're looking at on one deal, which is actually a really interesting deal for us, because we build all the product types. It's probably an 11 or 12 acre center, right? And we're going to shrink the retail, cut off a piece of us, do the housing, stack flats, and put some apartments in. And I think that's gonna happen in a lot of centers.
You're not putting the apartments on top of the retail.
No, so it turns out we're basically splitting them into three, right? So I think there's just gonna be a lot of reuse of these properties. Now, somebody like Sears, you know, the stuff that's tied up in the mall business, they got the REAs, and by the time they figure out how to unwind it, you know, that's just a headache.
But it's usually real good real estate.
Yeah, great real
You know,
estate.
regional malls are typically great access points, great
Right.
visibility. So I think over time, I think it gets
Sure.
recycled into something that's a positive. You know, owning the malls, you love getting those anchors back over time. You know, at first you said, oh, and then you said, wait a minute, let's think this out. They don't pay you anything. You know, let's go figure that out. Now, in the center that you're doing the apartments you're adding to it, is the center not a very productive center, I'm assuming?
Right now, it's pretty much vacant. Yeah.
Okay, all right, so this is a reuse.
Yeah, it's a reuse,
And-
but it's in a
and-
good location, so.
Yeah, but so it
Right.
can't be much better.
Right.
Tell us about, a little bit about apartments, and Peter, you're in it, and all of you know quite a bit about it. What is the deal with the apartments? I mean,
Right now, it's the prettiest girl with the dance.
no, I mean, without question.
I think the issue there is.
She's a Kardashian.
Actually, we're gonna have the bankers here at the apartments, but I mean, the way we look at it is, you know, we tied up a bunch of deals in the last, you know, during the dance cycle, or we took land that we own and we started, you know, re-entitling it. So we got a lot of stuff coming out of the ground in Colorado and in California. The way we look at it is, if we can get it, it's kind of a race, actually. What happens to the next cycle of apartments, right? You know, Wayne or.
What are rents, in your portfolios, what do rents look like and what are occupancies?
In apartments?
Yeah.
95% occupied, maybe it's $2 rents. You know, it depends where you are, okay? You know, San Jose, $250 in a good area, right? But you gotta look at job growth too. I mean, you take a look at where the apartments are being built this cycle, you know, it's all in the areas where there's phenomenal employment growth. You know, it's like San Jose, it's 3 times the national average, right?
There's got to be some concern about rent growth
Yeah.
at some point. We're
Well,
going to have pushback.
Our belief on that is that's kind of run, and it's starting to flatten out. I think it's gonna flatten out.
Is that right? We're starting to flatten it right around the.
Yeah, I think, you know, you've had really good rent growth in San Jose. You know, most people that have apartments up in San Jose is probably 8% last year. Over the whole portfolio, we were about 5%. But I think that you're gonna go back to the norm, which is around 2.8 to 3% in rent growth.
We're seeing the same thing. Northern California, kind of that, you know, Palo Alto up to the city. We've got 3 projects we're building right now. And the rent growth year over year from the last year is 10%.
Yeah.
And then yet down here in Southern California, we're not seeing the job growth and we're not really seeing the rent growth that we expected to see. And it's not flat, but it's you know, nowhere near, but it's all job growth.
It's positive.
It's positive, yeah. And our occupancies are similar, 95%. But the Bay Area, because of the job growth, is really a different market unto itself. The industrial side of the Bay Area is not as strong, notwithstanding the you know, the office R&D component for the tech guys. We've got a project up in Richmond, up in the North Bay, and it's been slow. We're doing a build-to-suit for Whole Foods Market for one of the distribution facility. But we've owned that land now for 6 years, and we've done one. You know, we've got 40 acres sitting there. We haven't been able to move it, and it's not the population isn't growing per se, where they need new distribution space versus Southern California. It's a very tight market. You still got the ports of Long Beach and Los Angeles. It's a national distribution center for the rest of the country. The market's less than 3% vacant. So, you know, again, Northern California, Southern California, there's different strengths.
Are you developing in Southern California?
We are.
So Southern California industrial is pretty good.
Yeah, you know, because Pat and I have the same financial partner. In the downturn, you know, our partner was there, and so we were able to buy some really good land. At the time, banks weren't lending money for what we did, which is speculative construction. So we built projects all equity. You know, there's not a lot of demand, but there was enough demand. And I would say there hasn't been a lot of rent growth, but there's enough growth. And so we have 4 million square feet underway today, and we've got activity on a lot of it.
4 million in Southern California?
Southern California.
Southern California,
Yeah.
4 million square feet?
Yeah.
Wow, and how much would you have had from 08 through 12? Zero.
Yeah, 200,000 cubic. Yeah.
200,000?
I mean, we're back. That's about what we did peak in 2005. And basically what's happened, Pat, is those were all projects that got delayed.
Right.
And then they're kind of all coming to closure right now. Yeah, oh
They're
yeah.
coming back on.
Yeah, and our pipeline's about 4 million square feet behind it, so, No, the industrial, we focus on big box. Vacancy rates are, sub 3%. So for Class A buildings, then you start getting into Class B and C buildings. You haven't seen the rent recovery there. You are seeing the vacancy there.
Peter, what do rents look like in industrial and the big box?
Infill markets, which would be Orange County and LA, were 60 cents net. So that's,
60 cent net?
60 cent net.
What were you in 1990?
In 1990, those buildings were 38 cents net.
Okay, so
Yeah.
so there's been...
Yeah.
Take another market like Ontario,
Yeah.
Cucamonga, what are the big box rents today?
Big box rents today are 38 cents.
What were they 15 years ago?
1992, we were leasing space in a down market, we were leasing space at 24 cents. Yeah, but what we haven't seen.
Values have tripled though.
Values have tripled because we used to buy buildings out there at 9.5 cap rates, and we're selling those buildings today at 5 cap rates.
Yeah, see, this is
Yeah, the cap rate.
The rents are the same,
Yeah.
the values are off the move.
Well, it's true, and what's interesting is, cap rates for Class A industrial got down to about 5%, 5.0% at the top of the last cycle called 2006. We're there today. But that's because there's so much money on the sideline trying to find income, which is what, Guy was saying on the CMBS side. There's just so much income there's so much money trying to be placed. The banks are doing a great job and being very conservative in terms of financing new development. So we've got a constrained market, but we've got a lot of people who need to put money to work. And so cap rates are as low as they've ever been, and people can't put their money on it.
Right. So huge flood of capital, great valuations. It's an interesting time to be a developer or owner of real estate, there's no question about it. Let's shift it a little bit, because I think you've done a fabulous job of giving us a sense of the market. I want to talk a little bit about California, okay? We're just, if you don't live here and like you said, we have similar shareholders, and when I talk to Ben Gifford, my boss, he thinks we've fallen into the ocean and doesn't know what the heck's going to go on. Are we as screwed up as everybody says we are, or are you guys all moving? You getting ready to move? I'm going to stay. You guys were at my house last night. I'm going to stay a little longer.
Only 4 months a year.
Only 4 months a year. But tell me a little bit about California. And Wayne, I want to start with you because I thought you were very articulate last night. Of course, I had a lot of wine, so maybe it wasn't. But talk to us a little bit about California and your view of California and why you think maybe what we're kind of goofing up here.
Well, I think the conversation revolved around taxation, government, infighting between local, state government. We can go through that in a deficit. But if I look at our education system, we're almost second to none in the world in California. And you look at Orange County, it's tremendous amount of business growth that happens in Orange County. You look at Los Angeles County, the number of entrepreneurial businesses nationwide, LA, #1. And that's because we are the face for the Pacific countries coming in. You look at venture capital, where's venture capital from? Northern California, because that's the tech hub. And I forgot the statistic, but we'll call it 60% of all venture capital in the United States ends up in Northern California. So California is very attractive from the entrepreneurial side. We do so much in terms of creating value in business. And last time I was talking about Orange County, and Orange County is leading the state clearly on the recovery on the unemployment side. And I think we're 6.8%, I think I read, on unemployment. And when I'm looking at the state's almost 10%. The country is 7.8%, but more meaningful, and I don't know the statistic for Orange County, is what we call the participation rate. And the participation rate is basically an adjustment for those who just gave up looking for a job, or those that said, I'm just retiring. And there's a lot of talk about the unemployment rate coming down because people have left the job market as opposed to jobs being created. And I believe in the United States and in California, it's probably pretty high, but I bet you in Orange County, we don't have that issue. We are creating jobs. We have a very good business environment in Orange County. I'm surprised it's not recovering a little bit more quickly. But if I look, the next 20 years, where do I want to have our business? Here in California. And
Steve, go ahead.
Yeah, I have a perspective, and I think it aligns with what you just said about the entrepreneurial nature of California. So I think we'll continue to see large businesses move what they can outside of California, whether it's the taxation, the regulation, it's just the cost of doing business. So particularly for low margin operations, they will migrate to other areas. So we're of the opinion, though, that small business entrepreneurial companies will continue to flourish in California, Southern California, as well as Northern California. So we're trying to create a business model that really adapts to nurture small business, entrepreneurial business. And it's a different model than dealing with big Fortune 500 companies. But for us to be successful long-term in California, we have to adapt to that. And we're convinced that that's where the growth is and that's where the future is of California.
Colin?
Yeah, I agree. I mean, I think I mentioned to you on the phone that, you know, it's California, the positive areas are tech-driven, right? I think I mentioned to you there's a website called represent.la, right? And I think it came out by I think it was the LA Business Journal put it out. It is unbelievable. You pull it up, there's like 800 startups showing this. And it's all, you know, Santa Monica, West LA, Silicon Beach, right? But I think that that's a real growth sector for Southern California. And, you know, we're looking at, you know, what does that mean for our business? Might mean smaller apartments. There's a couple of companies in the west side of LA that are doing an incredibly good job, you know, building apartments that are 350, 400 square feet, right? So, you know, what you said, Steve, is you gotta adapt, I think. But we're bullish on California.
Bullish on California.
Yeah, even though the state's a mess, I still think it's a great place to, the state government's a mess, it's a great place to live.
Yeah,
Right.
and you come from Ireland.
Yeah, right, I came all the way over here, I'm okay. Actually, it's really lousy back there.
Yeah.
Just all that real estate, it's really lousy back there.
Now, let me give a different perspective. Our business is industrial space distribution. We all eat food. It's coming through our warehouses. So we do fine on the distribution, but a number of the properties we have developed over the years are former manufacturers. So Boeing, Northrop, Libby, I mean, the list is everybody, you know, we grew up knowing, they've all left. And I think it's I love the rebirth and the tech and that because that is our future. But it's really sad to see. I've had the chance to sit with some very high-level executives at Northrop Grumman, and you know, what are you guys doing in California? We're trying to get out of California as fast as we can. And you know, every governor of every they always bring up the Texas governor, but there's other governors who personally call them to bring them to their states, and nobody in the state of California is calling these people. So it's just tragic. We'll survive, sure, for all the reasons everybody said. Southern California, all those engineering jobs we had. You know, there's a new group of young kids who are doing the tech, which is great, but it's at a different cost basis. They're not making the same kind of money. It's a tragedy, and we're just a high-cost, high-regulation state. And we had a user call us yesterday, 200,000 feet in the Inland Empire. They're doing distribution, but they're moving it to Arizona, where they're opening a new manufacturing plant they wouldn't consider California. And you know, it kind of hits you in the gut every time you hear that story, because you know we all depend on those types of companies to buy the houses, to buy the food. So anyway, we've got the emphasis on the wrong social, that's for sure, at the government level.
I agree with everything you said, but we're actually seeing a mini resurgence in manufacturing, totally different. I agree that the typical manufacturer, the aerospace, they're gone, they may never come back. But what we're actually seeing, and it's starting more in Northern California now, is some of the companies, I'll say Apple. So we have in the last year, we leased 10 buildings to Apple in Silicon Valley. So most of them are traditional uses. One of the buildings we're not allowed to go into. That's the only building. We're not allowed to go into that building. But I can tell you what they're doing in that building.
I want to know the guy that says, Mr. Brand, you can't go in. He gets to go. He wasn't told.
That lease provision may not be here next year. Let me tell you what they're doing in that building in the broadest sense. They're working on prototypes on how to manufacture, how to bring manufacturing from offshore to onshore. Don't know how they're doing it, I don't know what they're doing, but I can assure you it'll probably be with 2 people.
Sure, so like a marijuana place or something?
Manufacturing in California, I think we'll see some resurgence in it, but it'll be much, much different. It won't keep people in
domestic manufacturing.
Yeah.
We're seeing, I mean, we call it onshoring, but it's smaller guys. They own their own businesses, and to be competitive, they offshore manufacturing to China. Well, what they found out is the quality control, the costs in China, there's almost parity manufacturing overseas and here because of raw material costs and labor costs in China. So we've got a big project in Long Beach at the old Boeing facility there, Douglas Park. And the companies that we're bringing back, and they're really interesting industrial buildings. We call it 100,000 feet, 25,000 feet of office. So it's corporate headquarters, R&D, quality control, accounting. But that's a nice size office component. It's a very sticky industrial tenant. And then in the back, they're doing some kind of assembly. So they're not manufacturing parts here, but they are doing the value add here. They weren't doing that 5 years ago. 5 years ago, that was being done over in China.
Right.
So, my fear is, well, now they're going to move to Vietnam. But the reality is that hasn't been a great experience for smaller companies. The Apples of the world, and to a lesser extent, the aerospace companies, they really are forced to go out and try to source the cheapest cost of good, and I'm glad Apple's coming back. I don't think we'll see in Southern California the Apples, or not so much the Apples, more the aerospace, but these small companies, these 100,000, it is the American dream. We wouldn't recognize it.
So much on his side, very remarkable. But I worry about government interference and overregulation and all the growth unfunded pension liabilities, underfunded pension liabilities, CalPERS, CalSTRS, and those groups. And is there going to be more onerous taxation to one segment of the population that might chase out some potential growth prospects?
Split roll tax, are we going to see it?
Prop 13. I think I've been on that with Rex and all those other guys fighting that forever. It's going to get popular here. I think they averted it here with the 40% increase on the rich, or the people that make a lot of money. Because not all people make money are necessarily rich. They kind of leave that side over here, but I think that averted. Now governor's saying the budget balances here. But I think when you run into another issue, it's not going to be another tax increase. I think it's going to be right to the split roll.
Yeah, I think it is.
Everyone understands split roll, right?
If you don't, it's a commercial property is tied to Proposition 13 pursuant to a 2% increase per year. So a split roll, they're going to say commercial property, you're out of that. We're going to go market to market, and subsequently your taxes are going to skyrocket. Those are the decent.
Yeah, that was great. Last time they tried to do it, they got pretty far, but they included multifamily, and the multifamily has a voting base, so they scared all the tenants. This time they're going to be a little smarter. They're going to draft the language a little more clever, and they're going to exclude multifamily.
Yeah, I think it's something you really got to keep your eye on, and I just don't think it's a positive for anybody in the world. But, Peter, what keeps you up at night, man?
I'm not an economist with the federal debt. We've got record low interest rates, $16 trillion of debt. If interest rates double, that'll feel like $32 trillion overnight. That keeps me up. I mean, we get rising interest rates. I don't know how we're going to pay for the debt service at any level of government. So I think we just have way too much debt, and nobody's doing anything serious.
Nobody seems to be concerned about it.
Yeah.
I think it's a very good point. Yeah. Steve, what?
Well, besides too much red wine, I'm going to take a little bit of a different tack. I think to get remarkable results, you have to really build a remarkable company. And a comment that you made at the very beginning, you said we're on the down slope of the bell curve as far as sophistication in real estate. And I would agree with that in terms of ownership structure, capital. But as far as operating companies, I think we're in infancy. If you whether at Cal State Fullerton or Harvard in business school, you won't find case studies on successful real estate companies. So if you're trying to build a remarkable company right now in real estate, you have to go to other industries to model yourself. If you're trying to model yourself after other companies in real estate, you're shooting way too low in terms of how you deal with customers, technology, marketing. Any way you look at it, there's a very low bar in real estate. So if we want to attract talented people, we want the best people, not the best real estate people, but the best people. We have to build a more remarkable company. We have to do things that aren't being done by traditional real estate companies.
That's a great, because you made that point, and I wanted to bring that up. I think when we read everything, we hear that companies are cutting, and it's all real estate particularly, or office service, whatever it is, was an expense, and they're driving it down. Talk a little bit about your experiences in watching some of these companies.
Well, it's an interesting time. There's companies, I'll say, that are on defense. They're coming out of the Great Recession. It's about cost and cutting. But we're seeing more and more companies transition to offense. And what we mean by offense is they're looking at their workspace, they're looking at their company, how can they turn it into driving top-line revenue? So they're investing in their people, they're investing in their workplace with the idea of driving top line. The tech companies are clearly getting this, and they're leading the way, but more and more companies are following. So I think it's a real positive sign for the economy that more companies are going on the offense.
I do too. I think that's a really good point. That you can't cut your way to profitability.
Absolutely.
And I think we've all had to do that and cut it. You realize you got to reinvest in your people. They're your most important asset. They're is who drives your company, and you got to give them an environment where they're going to be successful. So I think it's a very major point.
And I'll just say one thing. Looking out at the audience, it makes me feel really good. There's great diversity here in the audience. A lot of the traditional real estate companies have historically looked like this.
They mean gorgeous.
That's exactly what I was thinking. But I think this room is a great reflection of where real estate is going, and I think that's really promising for the industry.
I agree. Quick, Colin, what keeps you up at night?
I think it's clearly the federal deficit, federal debt, and what happens to interest rates. You got two bankers here on the panel, right? I don't think we didn't talk much about interest rates. Clearly they're going to go up at some point in time, but nobody knows, right? What's your prediction?
No, and what we're doing in the frog in the pot. The pot being the interest rate is just slow pour out. You don't feel it's getting warmer and warmer, you get more comfortable. And if you look at interest rates, and when interest rates shot down to the floor, everyone was, wow, we've never seen these things. Now it's, 2%, that's fine. And now we're doing pro formas, 5-year pro formas, 2%, we're going to build a margin, we get 2.5%, right? And so I don't worry about 3 years. I don't think interest rates are going to spike within 3 years. I don't worry about 10 years because I think you're going to have rent growth and amortization of debt over that 10-year period of time. But think about your 5-year window. What is the probability that interest rates will rise? And you think about what we're underwriting cap rates, 4%. What is reality at 100 basis point swing? Probably pretty high. 100 basis point swing, that's 25% of your capitalization in the rate. That's a big thing. 100 basis points on a 7 cap rate, not going to change much. But 100 basis points on 4, you're over leveraged. And so that's what we really focus in. And I know that we have a number of the banks in the room that we do business with, and we're underwriting higher interest rates for that window, that takeout, because we're looking at that takeout of 4%, the takeout 6%, 7%, because we think that's more the reality in 5 years.
Great. Any questions? Carol?
Okay, Pat. As a member of the executive council at the university, I'm working with the associate director of the MBA program. And Pat, I just wanted to share, we're here to help the students. And I see a sign over here that says, ready to work, ready to lead. And I'm hoping, it's right behind you. And I'm hoping that you can reach out to the companies and the businesses here today to help enhance. Kate Guerrero's hoping that she can enhance the internship programs and part-time jobs or full-time jobs for the students who are coming out of the university. And I noticed in your program here that is one of your missions is student placement. If you could share that, I'd appreciate it.
That would be great. I think that, all of you, we represent, companies, whether they're small entrepreneurial or large institutions. You know what the internships do to your company. We've gone, recently, we didn't do it for years because we didn't have a guy that would get them corralled and make them productive. And it was driving us crazy. We got this kid sitting in the corner not doing anything. Well, now we bring in 6 or 7 a year. Some of them are from Cal State Fullerton, some of them are from SC. And just Fullerton seem to do a lot better. But if any of you have jobs, and they can be unpaid internships. These kids all need to put this on their resume now. Having 3 kids that have been now through that process, thank heavens. They're out of it and on their own now. But it's really important for us as industry to give back to get these kids started. And again, these can be very low-paying issues, they can be non-paying, however you want, you figure that out. But Carol, what's the best way for them to contact, who's gonna, if somebody in here has, hey, I want to contact Cal State Fullerton, how do they do that?
Well, if anyone wanted to reach out to me, that's fine. I'm happy to give you an introduction. The person to reach out to would be Kate Guerrero, and there's a lot of faculty and staff here today that can help you contact. She's the Associate Director of the MBA program at Mihaylo, and she's in career management. So Kate Guerrero, or I'd be happy to provide you with an intro to her.
Okay,
Thank
great,
you.
great. Hey, I told you 1:30, it's 1:29. I'll take one more question, it's got to be an easy one. I don't see when everybody wants to go home. Please thank these guys, I thought they did fabulous.